Hello class. In this video, we will take a closer look into monetary policy. From your reading, you should know now that by controlling the interest rate, we can affect investment spending, which leads to changes in aggregate demand. Let's take the example on the left. Example A. Pushing the interest rate down to the target rate. Well, if the Federal Reserve increases the money supply, this means that investment spending will be increased. Why? Because the interest rate is being lowered. This means that borrowing money is now cheaper for things like starting a business or buying a home. This increase in investment spending will lead to an increase in GDP. Also, through the multiplier process, we can also expect consumption spending to increase. This will also help GDP increase. So, an increase in the money supply will have the effect of aggregate demand increasing. This is why we call this type of policy expansionary monetary policy. Keyword on monetary, because it has to do with the money supply, which is controlled by the Federal Reserve. On the other graph, we have the opposite example. What if the Fed decides to increase interest rates? This would be contractionary monetary policy. As you see from the graph, interest rates would increase. This would cause investment spending and consumption spending to decrease, meaning that aggregate demand would be lowered. Hence, we are contracting the economy.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability.
So, under what circumstances would the Federal Reserve decide to increase or decrease the money supply? As Jerome Powell stated in the video, the Fed has a mandate from Congress to maintain stable prices and maximum employment. So, depending on the economic landscape of the country, the Fed has to decide what monetary policy to execute. In other words, will the Fed execute expansionary monetary policy or contractionary monetary policy? Let's take a look at the following videos to practice monetary policy.
While many standard economic statistics have yet to catch up with the reality we're experiencing, it's clear that the effects of on the economy are severe. Millions of workers are losing their jobs. Next week's jobs report is expected to show that the unemployment rate, which was at 50-year lows just 2 months ago, has surged into double digits. Household spending has plummeted as people stay home, and measures of consumer sentiment have fallen precipitously. Hotels, airlines, restaurants, department stores, and other retailers have been particularly hard hit. Manufacturing output fell sharply in March and is likely to drop even more rapidly this month, as many factories have temporarily closed. Overall, economic activity will likely drop at an unprecedented rate in the second quarter. Inflation is also being held down, reflecting weaker demand as well as significantly lower energy prices.
Let's do a quick recap of what Jerome Powell just described. As the video explains, unemployment seems to be an issue in the pandemic. Household spending is also down. And overall sentiment in the economy is down as well. This describes something that we have seen before in Unit 2. As you see from the graph, my current output, Y1, is below my potential output. Basically, what this means is that we are experiencing a recessionary gap. So what steps could the Federal Reserve take in order to alleviate the effects of this recessionary gap? As you can see from the graph, we must be able to go from our current equilibrium back to normal, which would be somewhere around equilibrium 2. In order to do so, the Federal Reserve must find a way to stimulate aggregate demand, which means that it must find a way to increase our aggregate demand. Let's take what we have learned from monetary policy to see how this could be done. In this case, the Federal Reserve must execute expansionary monetary policy. To accomplish this, the Federal Reserve must increase the money supply, as shown. This will have the effect of lowering our interest rate. How can the Fed increase the money supply? Open market operations. It must purchase T-bills or government bonds. The discount rate should be decreased, as well as the reserve requirement ratio. All of these together will have the effect of shifting aggregate demand to the right.
Both the depth and the duration of the economic downturn are extraordinarily uncertain and will depend in large part on how quickly the virus is brought under control. The severity of the downturn will also depend on the policy actions taken at all levels of government to cushion the blow and to support the recovery when the public health crisis passes. The Federal Reserve's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We're also committed to using our full range of tools to support the economy in this challenging time. Last month, we quickly lowered our policy interest rate to near zero. We stated then and again today that we expect to maintain interest rates at this level until we're confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. Job gains averaged 240,000 per month over the past 3 months, well above the pace needed in the longer run to absorb new entrants into the labor force. The unemployment rate remained low in February at 4.1%, while the labor force participation rate moved higher. Over the past 4 years, the participation rate has remained roughly unchanged. That's a sign of improvement, given that the aging of our population is putting downward pressure on the participation rate, and we expect that the job market will remain strong. Although the growth rates of household spending and business investment appear to have moderated early this year, gains in the fourth quarter were strong, and the fundamentals underpinning demand remain solid. Indeed, the economic outlook has strengthened in recent months. Several factors are supporting the outlook. Fiscal policy has become more stimulative. Ongoing job gains are boosting incomes and confidence. Foreign growth is on a firm trajectory, and overall financial conditions remain accommodative. Overall consumer prices, as measured by the price index for personal consumption expenditures, increased 1.7% in the 12 months ending in January. The core price index, which excludes the prices of energy and food and is typically a better indicator of future inflation, rose 1.5% over the same period. However, as we have noted for some time, the shortfall of inflation from 2% reflects, at least partly, some unusual price declines that occurred nearly a year ago. In coming months, as those earlier declines drop out of the calculation, inflation should move up closer to 2% and stabilize around that level over the medium term. Of course, various forces will continue to affect inflation. At times, it may be above 2%, just as at times it may be below. Our inflation objective is symmetric in the sense that we are trying to prevent persistent deviations from 2% in either direction.
What Jerome Powell basically is describing is an inflationary gap, where the only problem that the Federal Reserve sees is that maybe the economy is moving a little bit too fast, meaning that prices are forecasted or are beginning to be seen as problematic. So, the purpose of the Fed here would be to control prices, control the economy, and basically take us from our current equilibrium number 1 to maybe equilibrium 2. We can accomplish this by decreasing our aggregate demand. So the Federal Reserve must find a way to decrease output, to decrease aggregate demand. This is what we call contractionary monetary policy. How can the Federal Reserve achieve these? We go back to our money market. In this case, the Federal Reserve must find a way to decrease aggregate demand. It can do so by increasing the interest rate. This will have the following effect on consumption and investment. So how can the Federal Reserve increase the interest rate? Let's go back to our 3 tools for monetary policy. Open market operations. In this case, the Federal Reserve must sell government bonds or treasury bills. It must also increase the discount rate as well as the reserve requirement ratio. Altogether, this is what we call contractionary monetary policy. And it looks something like this. In the graph, we now go from our first equilibrium to our second equilibrium. We now have our desired result, an increase in the target federal funds rate.
The job market remains strong, the economy continues to expand, and inflation appears to be moving toward the FOMC's 2% longer run goal. As you already know, we decided today to raise the target rate for the federal funds rate by 1/4 percentage point, bringing it to 1.5 to 1.75%.